250,000 rupees per kilogram of silver? If you think that sounds impossible, what I'm about to reveal in the next 20 minutes will completely change your perspective on the silver market. There is a specific date coming up, and if you miss this date, you will watch silver prices explode to levels that will make current prices look like an absolute gift. I'm talking about COMEX Registered Silver Inventory at the lowest levels in over 15 years, while industrial demand is hitting all-time highs. I'm talking about a delivery squeeze that's building right now that could trigger the biggest short squeeze in commodity market history, and I'm talking about a countdown that starts right now. Mark your calendar for May 15th, 2026, because that's the date when the April silver futures contracts go into delivery, and there is not enough physical silver in the COMEX vaults to satisfy even 20% of the open interest demanding delivery. This is an emergency alert. What's about to happen in the silver market will rewrite the rules of precious metals investing. Let's get into this immediately. So what exactly is happening right now that makes May 15th such a critical date? Let me set the scene for you, because the situation has been developing quietly over the last 6 months, and it's now reaching a breaking point. The COMEX silver futures market operates on a contract cycle where contracts expire in specific months. The biggest delivery months are March, May, July, September, and December. We're currently in late March, which means the May contract, which is the next major delivery month, is starting to come into focus. As of this morning, open interest in the May silver contract stands at 73,400 contracts. Each contract represents 5,000 ounces of silver. That means there are 367 million ounces of paper silver claims for May delivery. Now let me tell you what's sitting in COMEX registered silver vaults ready for delivery. 48 million ounces. Let me repeat that. 367 million ounces claimed, 48 million ounces available. That's a ratio of 7.6 to 1. Show chart. COMEX Registered Silver Inventory versus May contract open interest. But here's what makes this situation absolutely explosive. Unlike previous years, where most traders cash settle their contracts and roll forward to the next delivery month, we're seeing unprecedented standing for delivery intentions already. Industry sources are reporting that large institutional buyers, industrial users, and sovereign wealth funds have filed notices indicating they intend to take physical delivery of over 90,000 contracts across the May and July delivery periods. That's 450 million ounces of silver demand against total COMEX registered inventory of just 48 million ounces. The math doesn't work. It's physically impossible to deliver that much silver because it doesn't exist in the registered vaults. This is the definition of a delivery crisis, and May 15th is when the settlement window opens and the scramble begins. Over the last 48 hours, we've started seeing the first signs of panic in the professional silver trading community. Physical silver premiums in India have spiked from the normal 3,000 to 4,000 rupees per kilogram over spot price to 11,000 to 14,000 rupees over spot. That's a premium surge of over 250%. Dealers in Mumbai, Delhi, and Ahmedabad are reporting that they cannot source physical silver in large quantities. Orders above 100 kilograms are facing delivery delays of 6 to 8 weeks, compared to the normal 1 to 2 weeks. Meanwhile, the paper silver price on COMEX is still trading around $29 per ounce, which is roughly 94,000 rupees per kilogram at current exchange rates. The disconnect between the paper price and the physical price has never been wider. When premiums explode while paper prices remain subdued, it's a clear signal that the paper market is broken and a repricing event is coming. 320. Let me explain why May 15th specifically matters in the COMEX delivery process. When you hold a futures contract going into the delivery month, you have several options. You can close your position by selling the contract back to the market. You can roll your position forward to a later delivery month, or you can stand for delivery, which means you're demanding physical silver be delivered to you at a COMEX-approved warehouse. The critical dates in the May contract cycle are May 1st, which is first notice day when sellers can begin issuing delivery notices to buyers, and May 15th, which is when the bulk of delivery intentions must be declared and matched. Between May 1st and May 30th, which is last trading day, there's a scramble where longs who want physical and shorts who need to deliver try to find each other. But what happens when there are 7 times more longs demanding delivery than there is physical silver available? Either the price has to spike dramatically to convince longs to cash settle instead of taking delivery, or the exchange has to declare force majeure and change the rules, or shorts have to buy physical silver from the spot market at whatever price necessary to fulfill their delivery obligations. All 3 scenarios result in massively higher silver prices. Now let's dig into the COMEX inventory data, because this is where you'll understand the true magnitude of the crisis that's building. COMEX Silver Inventory is divided into two categories: registered and eligible. Registered silver is silver that has been assayed, meets quality standards, and is specifically designated as available for delivery against futures contracts. Eligible silver is silver that meets quality standards and is stored in COMEX warehouses but is not currently designated for delivery. Think of registered as for sale and eligible as in storage. The crucial metric is registered inventory because that's what's actually available to satisfy delivery demands. As I mentioned, registered silver currently sits at 48 million ounces. But here's what's terrifying. 6 months ago, registered silver was at 87 million ounces. 12 months ago, it was at 112 million ounces. We've seen a decline of 57% in registered inventory in just 1 year, while open interest has increased by 32%. Show chart. COMEX Registered Silver Inventory 24-month trend. Where is all this silver going? The delivery reports show massive withdrawals from COMEX vaults heading to Switzerland for refining and then onward to Asia. In the last 90 days alone, we've seen net outflows of 23 million ounces from registered vaults. That's 48% of current registered inventory leaving in just 3 months. The silver is being pulled to India, China, and the Middle East, where physical demand is insatiable. India's solar panel manufacturing capacity has tripled in the last 2 years as the government pushes renewable energy. Each gigawatt of solar capacity requires approximately 25 tons of silver. China's electric vehicle production is at record levels, and each EV uses between 25 to 50 grams of silver in electrical components. These are not discretionary demands that disappear when prices rise. These are industrial demands from growing sectors that need silver regardless of price, because there is no substitute that matches silver's electrical conductivity and thermal properties. Let me show you something about the silver market structure that most investors don't understand, but which is absolutely critical to predicting what happens next. The silver market is much smaller than the gold market in terms of total above-ground supply and annual production. Annual silver mine production is approximately 850 million ounces globally. Annual industrial demand is approximately 600 million ounces. Investment demand is approximately 200 million ounces. Jewelry and silverware demand is approximately 150 million ounces. When you add those up, you get 950 million ounces of total demand against 850 million ounces of supply. That 100 million ounce deficit is being filled by recycling and drawdowns from above-ground stocks. But here's the problem. Above-ground stocks are not infinite, and recycling flows are price-sensitive. When silver prices are low, recycling slows down because it's not economically viable to melt down old electronics and extract tiny amounts of silver. This means that in a supply crunch scenario, new supply cannot come online fast enough to meet the demand surge. 8:15. Now let's talk about what they don't want you to know regarding price manipulation in the silver market. The silver market has a long history of manipulation by large banks trading on the COMEX. JP Morgan paid over $1 billion in fines for spoofing and manipulating precious metals markets between 2008 and 2016. Spoofing is the practice of placing large sell orders to drive prices down, then canceling those orders once lower prices trigger stop losses, then buying at the lower prices. The Department of Justice and the Commodity Futures Trading Commission have documented thousands of instances of this behavior by major banks. Why do banks manipulate silver prices downward? Because many of them hold large short positions in silver futures, and they profit when prices decline. But manipulation only works when there's no physical delivery pressure. When industrial users, investment funds, and sovereign buyers start demanding physical delivery instead of cash settlement, the manipulation breaks down because you cannot deliver paper silver to someone demanding physical bars. The current short position in COMEX silver is absolutely staggering. According to the latest Commitment of Traders report, commercial traders, which are primarily large banks, hold a net short position of 237 million ounces of silver. That's 66 days of global mine production that they're short. In a normal market, being short means you're betting prices will go down so you can buy back at lower prices and profit from the difference. But what happens when prices start rising rapidly and you're short 237 million ounces? You have to buy silver to cover your short position, which pushes prices even higher, which forces more shorts to cover, which creates a feedback loop called a short squeeze. The Hunt Brothers silver squeeze in 1980 took silver from $6 to $50 in a matter of months. The meme stock short squeezes in 2021 took GameStop from $20 to $480. When short squeezes happen in markets with limited supply, the moves are exponential, not linear. Show chart, COMEX Silver Commercial Net Short Position Historical Comparison. Let me explain the industrial demand side of this equation because it's the industrial demand that makes silver fundamentally different from gold. Gold is primarily a monetary metal and a store of value. Less than 10% of gold demand comes from industrial applications. Silver is the opposite. Over 60% of silver demand is industrial, and that percentage is growing as new technologies require more silver. Solar panels, electric vehicles, 5G infrastructure, medical devices, water purification systems, RFID chips, batteries, semiconductors. All of these technologies require silver and cannot function without it. And here's the crucial point. When an industrial user needs silver for manufacturing, they will pay whatever price necessary to secure supply because shutting down a factory due to lack of raw materials is far more expensive than paying higher input costs. This inelastic demand creates a price floor that rises as supply tightens. Industrial users are now competing directly with investors for physical silver, and industrial users have deeper pockets and more urgent timelines. The Chinese silver market is sending very clear signals right now that smart money is accumulating aggressively. The Shanghai Futures Exchange Silver Premium, which is the difference between Shanghai silver prices and London silver spot prices, is currently at 78 cents per ounce. That might not sound like much, but historically, an SFE premium above 50 cents indicates strong Chinese demand. During the 2020 pandemic squeeze, the SFE premium hit $2.40 before silver prices exploded from $14 to $30. We're in the early stages of a similar setup. Chinese manufacturers are building inventory ahead of anticipated price increases. Chinese retail investors are buying silver coins and bars at record rates. The Shanghai Gold Exchange, which also trades silver, has seen silver vault withdrawals accelerate by 43% in the first quarter compared to the same period last year. When the world's largest manufacturer and second largest economy is pulling physical silver out of vaults and into private hands, you need to pay attention. All right, let's get into the technical analysis and chart structures because while fundamentals tell us why silver is going higher, technicals tell us when and how the move will unfold. On the monthly time frame, silver has been consolidating in a massive symmetrical triangle pattern for the last 3 years. The upper boundary of this triangle connects the highs from May 2021 at around $30 and the February 2023 high at around $26. The lower boundary connects the lows from September 2022 at around $17 and the November 2023 low at around $21. These two trend lines are converging, and we're now at the apex of the triangle, which is typically where the breakout happens. Symmetrical triangles are continuation patterns 65% of the time, meaning they break in the direction of the prior trend. The prior trend before this triangle was up from $12 in March 2020 to $30 in February 2021. This suggests a high probability of an upside breakout. Show chart, silver monthly with symmetrical triangle pattern. The measured move target for this symmetrical triangle is calculated by taking the widest part of the triangle, which was approximately $13 from the 21 high at $30 down to the 22 low at $17, and adding that to the breakout point. If we break out from the current apex around $29, the measured move target would be $42. But here's what makes this setup even more powerful. That $42 target is just the technical projection. It doesn't account for the fundamental supply squeeze and potential short squeeze we've been discussing. If those factors come into play simultaneously with a technical breakout, we could see silver move far beyond $42 in a very short period. $50 to $60 becomes realistic, and $75 to $100 becomes possible in a true blow-off top scenario. At $100 per ounce, that's roughly 325,000 rupees per kilogram, which is even higher than the 250,000 I mentioned in the title. On the weekly chart, we're seeing a bull flag pattern developing that's been forming since the December high. A bull flag is a consolidation that forms after a strong upward move, and it typically resolves with a continuation to the upside. The flagpole was the move from $24 in early November to $30 in early December. The flag is the tight consolidation we've been in from December through March, trading between $27 and $30. Bull flags on weekly charts are highly reliable patterns with a success rate of over 70%. The tighter and longer the consolidation, the more explosive the breakout tends to be. We've now been in this flag for 14 weeks, which is a significant consolidation period. When this breaks to the upside above $30 with confirmation, I expect a very rapid move toward $35 to $38 in the first leg. Show chart, silver weekly with bull flag pattern highlighted. The daily time frame is showing an ascending triangle pattern, which is a bullish continuation pattern identical to what we discussed with gold. We're making a series of higher lows at $28.20, $28.50, $28.70, and $29, while repeatedly testing horizontal resistance at $30. We've tested $30 7 times in the last 8 weeks without breaking through, but each test weakens the resistance. Ascending triangles have an 81% success rate of breaking to the upside, according to Thomas Bulkowski's Pattern Encyclopedia. The measured move for this ascending triangle is calculated by taking the height at the widest part, which is approximately $2, and adding it to the breakout point at $30, giving us a target of $32 in the immediate move after breakout. But that's just the first target. Once we clear 32, there's no significant resistance until we reach the 35 to 36 zone. Show chart, silver daily with ascending triangle and higher lows marked. On the 4-hour time frame, I'm watching several momentum indicators that are setting up for an imminent breakout. The relative strength index is at 64, which is in bullish territory but not yet overbought. This tells us there's room to run higher before we hit exhaustion levels. The MACD is showing a bullish crossover with the MACD line above the signal line and the histogram printing green bars. This momentum shift typically precedes sustained moves. The stochastic oscillator has crossed bullish in oversold territory and is now rising, which is a classic buy signal. When multiple momentum indicators align on the same time frame, it increases the probability of a significant move. I'm also watching the volume profile on the 4-hour chart. We've seen declining volume during this consolidation at the $30 resistance, which indicates sellers are getting exhausted. When we do break above $30, I'll be looking for a volume surge to at least 200% of the 20-day average to confirm institutional participation. Show chart, silver 4-hour with RSI, MACD, and stochastic. Support levels are critical to understand for risk management and for identifying potential buying opportunities if we get a shakeout before the breakout. The first support is at $28.80, which is the most recent higher low in the ascending triangle. Below that, we have major support at $28, which is a psychological level, and also the 50-day moving average. If we somehow break below $28, the next support is at $27.20, which represents the 38.2% Fibonacci retracement of the November to December rally. But given the physical demand situation and the upcoming May delivery crisis, I think the probability of a sustained breakdown below $28 is less than 15%. Any dip toward $28 should be viewed as a gift and a buying opportunity, not a reason to panic. So let's talk about where silver is headed and what you need to watch over the next critical weeks. My timeline and price targets are based on the convergence of technical breakout patterns, the COMEX delivery crisis, and the industrial demand surge we're experiencing. Here's my roadmap. Between now and April 30th, I expect silver to break above $30 and make a move toward $35 to $38. This move will be driven by speculative momentum traders front-running the May delivery squeeze and by early covering from small short positions. This is the accumulation phase where smart money is building positions before the crowd realizes what's happening. If you're going to enter silver, this current window between $28.50 and $30 is your best risk-reward entry point. Show chart, silver with projected price path and timeline marked. Between May 1st and May 15th, which is the critical delivery notice period, I expect silver to spike toward $45 to $55. This is when the COMEX delivery squeeze becomes apparent to the broader market. Shorts who thought they could roll their positions forward will realize there's not enough physical silver to deliver, and they'll be forced to buy at any price to cover. Longs who are standing for delivery will refuse to cash settle because they understand the premium on physical silver is massive, and they want the actual metal. This standoff creates explosive volatility and rapid price appreciation. During this 2-week window, we could see daily moves of $3 to $5, which are enormous in percentage terms for silver. A $5 move on a $30 base is a 16% move in a single day. This is where fortunes are made for those who are positioned correctly. From mid-May through July, depending on how the COMEX resolves the delivery crisis, I expect silver to consolidate between $50 and $70 before potentially making a final blow-off top move toward $80 to $100. If the COMEX changes delivery rules or suspends trading, which they've done before in extreme situations, it could actually accelerate the physical market premium even more because it would prove that paper silver is not real silver. The premium on physical bars and coins could explode to 50 to 100% over spot, which would drag the paper price higher as arbitrage traders try to close the gap. In Indian rupee terms, $100 per ounce translates to approximately 325,000 rupees per kilogram. That's a 130% gain from current levels of around 140,000 rupees per kilogram. Now here's what you need to understand about participating in this move. Physical silver is always preferable to paper silver if you can manage the storage, security, and liquidity considerations. When you buy physical silver coins or bars from a reputable dealer, you own real metal that cannot be hypothecated or rehypothecated by banks. However, physical silver comes with premiums that are currently very high due to the supply shortage. If you're buying physical in India right now, you're paying 10 to 15,000 rupees per kilogram over spot price, which is a significant premium. For those who want exposure without dealing with physical storage, silver ETFs like iShares, Silver Trust, or sovereign silver bonds are alternatives, but understand that you're still in the paper system and subject to counterparty risk. If the COMEX declares force majeure, your ETF might cash settle at prices far below the physical market price. For traders looking to capture the volatility, silver futures and options offer leverage, but they also come with substantial risk. A 5% move in silver translates to a 50% gain or loss on a 10 times leverage futures position. Only trade futures if you have experience, proper risk management, and the emotional discipline to handle extreme volatility. For most retail investors, I recommend building a core position in physical silver now, before the May squeeze, and then potentially adding exposure through ETFs or silver mining stocks as the breakout unfolds. Silver mining stocks typically leverage silver price moves by a factor of 2 to 3, meaning a 30% move in silver often translates to a 60 to 90% move in quality silver miners. But mining stocks also come with operational risks, political risks, and management risks that pure silver doesn't have. Look, the bottom line is this. We are on the verge of the most significant silver market event in over 40 years. The delivery crisis building on the COMEX is not speculation. It's mathematics. There are 7.6 paper claims for every ounce of registered silver. Industrial demand is at all-time highs and accelerating. Physical premiums are exploding globally. Chinese and Indian buyers are pulling metal out of vaults at record rates. Short positions held by commercial traders are at extreme levels that will be impossible to cover without massive price spikes. And we have a specific date, May 15th, when all of these factors converge and the delivery intentions must be declared. This is not a drill. This is an emergency alert for everyone who understands precious metals markets. The 250,000 rupees per kilogram figure I mentioned in the title is not hyperbole. It's a realistic target based on where silver could trade if we get a full-blown short squeeze combined with a COMEX delivery failure. At $100 per ounce, which is where silver traded in inflation-adjusted terms in 1980, we're looking at 325,000 rupees per kilogram. That's a 130% gain from today's prices. But here's the critical point. By the time the mainstream media is talking about the silver squeeze, by the time your neighbor is asking you how to buy silver, by the time CNBC is running special reports on the COMEX delivery crisis, the easy money will already be made. The time to position is now, while silver is still in the accumulation phase, while it's consolidating below $30, while the crowd is still ignoring it. I cannot stress enough how rare these setups are in financial markets. You might see an opportunity like this once or twice in a decade. The last major silver squeeze was in 2020 during the pandemic when silver went from $14 to $30 in a few months. Before that, you have to go back to the 2008 financial crisis or the 2003 to 2011 bull market. These moves don't happen often, but when they do, they create generational wealth for those who are positioned. The question is, will you be one of those who looks back and says you saw it coming and took action? Or will you be one of those who says you knew it was going to happen but didn't pull the trigger? So what do you think is going to happen? Are we going to see silver hit $50 by May, or will the COMEX find a way to diffuse this delivery crisis? Do you think $100 per ounce is realistic, or am I being too aggressive with that target? Drop your price predictions in the comments below. I want to hear where you think silver is going and whether you're buying physical trading paper or staying on the sidelines. And if you found this analysis valuable, if this video opened your eyes to what's about to happen in the silver market, I need you to smash that like button right now. This information needs to reach as many people as possible before May 15th. Subscribe to this channel and turn on all notifications because the next few weeks are going to be absolutely wild, and I'll be here giving you daily updates as the situation develops. When the COMEX delivery numbers come out, when premiums spike, when the price breaks out, you'll hear about it here first with the data and analysis you need to make informed decisions. Until next time, stay alert, stay prepared, and remember, in a world of paper promises, silver is real money. I'll see you in the next one.